Iron Financial. This is the place where we forge stronger portfolios by cutting right through the market's weakness. I'm your lead analyst. So, Blackstone, they just came out with what they are calling, and I quote, the best results in our 40-year history. A truly record-shattering quarter that you better believe sent some serious ripples all through Wall Street. But you know, here at Iron Financial, we don't just take a press release at face value. No way. We put it under the microscope. We're about to stress test this financial fortress they've built and really see if it's as solid as they claim. All right, let's get into it.
Okay, first things first. We need to wrap our heads around the sheer scale we are dealing with here. Blackstone isn't just another company playing in the alternative asset space. For all intents and purposes, it is the space. They are the undisputed global titan, the benchmark, the name that everyone else measures themselves against. You know, their influence, it stretches from the commercial real estate you probably drive past every single day to the private companies behind the brands you buy, from the massive global credit markets to the infrastructure, the roads, the bridges, the data centers that you rely on. They literally touch almost every single corner of the global economy. So believe me when I say, when Blackstone makes a move, the market doesn't just listen, it holds its breath.
And this is the number that makes it all possible. $1.3 trillion in assets under management. Just let that number sink in for a second. It's almost an impossible figure to comprehend. This isn't just a number on a page. It is the concrete foundation of a modern financial empire. It represents an immense amount of trust that the world's largest, most sophisticated investors have placed in this one firm. This colossal pool of capital gives them an almost unparalleled power to go out and acquire companies, to reshape entire industries, and to generate returns on a scale that can literally move global markets. This, right here, is the very bedrock of the fortress.
Whoa, hold on a minute. Indestructible? That's a very, very strong word. I'm the market skeptic around here, and my job is to cut through the hype. You have to remember, every single empire has vulnerabilities. Every single one. And a fortress this large, it casts an incredibly long shadow, and you know what? Shadows are great at hiding things. So the real question we need to answer today, the one that really matters, is this. Is this a story of pure unassailable strength, or is the market so dazzled by the size that it's overlooking critical, dangerous weaknesses? In other words, is this hype, or is it real?
That's a fair challenge, a very fair challenge. And to answer it, we have to do what any good engineer would do. We have to examine the blueprint. We're going to start by dissecting the actual architecture of this record-breaking quarter. We're going to look at the load-bearing walls of this thing. I'm talking about the revenue, the earnings, the raw financial power that is supposed to be supporting this entire massive structure. Let's get into the hard numbers.
All right, look at this. What is truly fascinating here is the sheer, overwhelming force of these Q4 results. Let's see our win on distributable earnings. Now, for those of you at home, think of this as the actual cold, hard cash profit that's available to be paid out to shareholders. For a firm like Blackstone, it's probably the most important metric. They delivered a stunning $1.75 per share. Now, why is that stunning? Because Wall Street was only expecting $1.52. That's not just a beat. That's not just a win. That is a 15% surprise. That's a knockout punch. And it's the exact same story for revenues, which also absolutely crushed expectations. Look, these aren't just good numbers. They are a statement. They're telling the world that even in a complex and uncertain macro environment, Blackstone has explosive, undeniable earning power. This is that top-line strength that builds the fortress's thick outer walls.
But, you know, a fortress needs more than just strong walls, right? It needs a constant, reliable supply line. For Blackstone, that supply line is capital. So now let's look at the engine that fuels this entire operation, the absolutely relentless, non-stop inflow of new money. This is the lifeblood, this is the raw material that they use to go out and build their empire, piece by piece.
And this chart right here, it just brilliantly illustrates the raw power of that engine. In the fourth quarter alone, just 3 months, they pulled in $71 billion in new capital. That is the highest amount they've raised in a single quarter in over 3 years. And for the full year, a staggering, mind-boggling $240 billion. And you have to understand, this isn't just passive money that's sitting on the sidelines waiting. No, this is a tidal wave of fresh capital from every single corner of the investment world, just pouring into Blackstone's coffers. It gives them more and more firepower to deploy into the markets. This kind of momentum is a critical indicator of the market's confidence in their strategy.
So with all that money coming in, where are the earnings actually coming from?
This chart is so important because it shows the diversified pillars that are supporting the whole structure. Now you see, private equity is the largest single contributor at 37%. That's their traditional powerhouse, their bread and butter. But look at the balance here. Real estate is bringing in a solid 30%, and credit and insurance is right on its heels at 25%. This tells you one thing very clearly. This is not a one-trick pony. Not at all. This is a multi-engine machine, with each of these segments carrying a significant portion of the load. This diversification, it's designed specifically to provide stability. It ensures that if one pillar, say, faces some economic headwinds, the others are strong enough to maintain the integrity of the entire structure.
Okay. Diversification always looks good on a pretty pie chart, but I have to push on this. What is the quality of these inflows? And really, how sustainable is this balance? Are we looking at strong, stable, long-term commitments here? Or is this hot money that could flow out just as quickly as it flowed in if things get a little choppy? Is there some kind of hidden dependency here, a weak link in the chain that makes this fortress a lot less stable than it appears on the surface? We need to dig a lot deeper into where this money is actually coming from.
The answer to that really important question lies right here. The heavy lifting, the true unshakable foundation of this entire enterprise, it comes from the most stable and the most patient source of capital on the entire planet: institutional investors. We're not talking about day traders. We are talking about massive pension funds that manage your retirement money, sovereign wealth funds that manage the fortunes of entire nations, and huge university endowments. This is not fickle retail money that panics at the first sign of trouble. No, this is long-term, strategic, committed capital.
And hey, you don't have to take my word for it. The president and COO, Jonathan Gray, he said it himself, crystal clear. These investors are the bedrock. They provide that deep, solid, unshakable foundation upon which everything else is built. You have to understand, these institutions commit billions of dollars for fundraising cycles that last for years, sometimes even for decades. This is the absolute core of Blackstone's strength, and it's the source of its incredible stability and its predictability, year in and year out. But that bedrock, as solid as it is only the beginning. They are actively bringing in reinforcements from every single flank. Just look at the private wealth channel. That's money from individual high net worth investors. Fundraising there grew an absolutely incredible 53% year over year to $43 billion. That means they are successfully tapping into this massive growing market. Then you look at their insurance channel. The assets under management there are up 18% to a massive $271 billion. And maybe most important of all, look at what they call perpetual capital. This is essentially permanent money. It has no expiration date, unlike traditional funds that have to sell assets and return capital after a set number of years. It now makes up nearly half of their total fee-earning assets. What that means is it provides a steady, predictable, almost annuity-like stream of revenue that fortifies the entire structure against any storm.
All right. So they're a fortress when it comes to gathering assets. I'll concede that point. Their capital engine is absolutely second to none. But here's the thing. A fortress isn't ultimately judged by how much treasure it holds inside, it's judged by how well it defends that treasure. Raising money is one skill. Generating returns on that money is a completely different one. So I think it's time we stop looking at the blueprints and we start actually inspecting the walls for cracks. Let's talk about performance.
Okay, let's go inspect the armory, because from where I'm sitting, it looks fully stocked and ready for battle. As you can see, the weapons are absolutely firing. Their infrastructure fund, which is focused on essential assets that society can't live without, returned a massive 24% for the year. Corporate private equity, which is their bread and butter, delivered a really solid 14%. And check out their private credit strategy, lending directly to businesses. It posted an 11.2% gross return in what was a very tricky environment for credit. And even Bright, their huge private real estate fund, it returned over 8% net to investors. Now, that might not sound huge, but it's nearly triple what the public REIT index did over the same period. The point here is, in these key strategic areas, the performance is undeniably powerfully strong.
Not every area. See, that's the thing. You're highlighting all the powerful cannons that are firing perfectly, but you're conveniently ignoring the part of the wall that's starting to crumble. Every fortress, no matter how big, has a blind spot, an Achilles heel. And in Blackstone's trillion-dollar empire, that weak point is glaring. It's obvious, and it's hiding in plain sight.
And here it is. This is the crack in the foundation that you cannot ignore. Since this whole interest rate hiking cycle began, the S&P 500 has soared an incredible 75%. It has been one of the great bull runs in recent memory. Now, during that exact same period, what happened to Blackstone's massive real estate portfolio? The second largest pillar of their entire earnings structure. Its values have fallen by 16%. That is a staggering, jaw-dropping divergence. It's not just underperformance, it is a massive, heavy anchor dragging on the entire firm, while the rest of the market has been on an absolute tear. This right here is the weak point.
Look, the numbers do not lie. For the full year, the total real estate portfolio appreciated by a meager 1.5%. And their opportunistic funds, the ones supposed to be making big, bold bets, actually lost value. You cannot just sweep that under the rug. But, and this is a critical piece of context that you have to hear from management, 75% of their real estate equity isn't in those troubled sectors you read about, like traditional office space, which is still reeling from the work-from-home revolution. No, it's concentrated in what they see as the absolute strongest areas of the market: data centers, logistics warehouses, and rental housing. They firmly believe they are positioned in the right neighborhoods of what is admittedly a very tough city. So while the headline numbers are undeniably weak, the underlying quality of the portfolio might just be stronger than it first appears.
Acknowledging a weakness is one thing, but the real story, the one that matters for investors, is how you respond to it. And Blackstone's strategy has always been to play offense. So while one part of the fortress is being reinforced, they are simultaneously preparing for the next major campaign with a truly massive war chest. Let's take a look at exactly how they plan to deploy it.
This is their response: nearly $200 billion in what they call dry powder. Let's be very clear, this isn't just cash sitting in a bank account. This is a colossal war chest. It represents an almost unimaginable amount of firepower that is ready to be deployed into the market at a moment's notice. Think about it. At a time when many competitors are retreating, licking their wounds, Blackstone has the ammunition to go on the offensive, to acquire assets on the cheap, to fund the next generation of new ventures, and to basically dictate the terms of the next cycle of deal-making. This is their ultimate weapon.
You know, a war chest is only as good as the general who's deploying it. Having $200 billion lying around is very impressive, but it also presents an immense challenge. How in the world do you deploy that much capital effectively without dramatically overpaying, or even worse, chasing bad deals in a crowded market? It's really easy to put a big flashy number up on a slide, but what's the actual battle plan? Show me the strategy. Is this just marketing fluff, or is there a real coherent plan to turn this mountain of cash into actual returns for investors?
There is a clear, multi-pronged strategy in place. Step 1 is targeting very specific thematic areas. They're not just buying the whole market, they are laser-focused on what they see as the biggest generational opportunities out there: the AI revolution, the massive build-out of digital infrastructure needed to support it, and the global energy transition. Step 2 is capitalizing on the market's own resurgence. The very successful IPO of their company Medline proved that the public markets are open again for business for high-quality companies, and you better believe Blackstone has a deep pipeline of companies ready to go. And Step 3 is just aggressive expansion. They're targeting over $50 billion for new private equity funds and pushing much deeper into high-growth regions like Asia and entirely new channels like the 401k market.
And at the absolute core of that entire deployment strategy is this one incredibly powerful theme: artificial intelligence. On their earnings call, management made it absolutely clear this isn't just a buzzword for them. This isn't just something to mention to analysts. They see the AI revolution as a fundamental rewiring of the entire global economy. And they're not just buying AI software companies. No, they're buying the picks and shovels of the AI gold rush, the massive data centers that power the models, the new power generation that's needed to keep those data centers running 24/7. They even hired the former global head of AI from McKinsey to lead the charge. They are betting the future of the entire fortress on getting this one theme right.
So, we've examined the blueprint, we've inspected the walls, we've definitely found the cracks, and we've reviewed the battle plan for the future. Now it's time for the final assessment. We've brought all the evidence together, the good and the bad. Let's render the iron financial verdict. Is Blackstone a golden opportunity for your portfolio, or is it a dangerous trap?
From my perspective as the analyst, the case is pretty clear. This fortress is fundamentally built on iron. The strengths are just undeniable. You have unparalleled scale that creates a competitive moat that's almost impossible for anyone else to cross. You have a diversified and incredibly powerful capital gathering engine that just churns out hundreds of billions in new assets year after year. And you have that immense war chest of nearly $200 billion aimed squarely at the next generation of technological growth. They have the resources and they have the strategy to not just weather storms, but to actually dominate the coming economic cycle.
But, and this is a huge but, you absolutely cannot ignore the risks. That 16% decline in their massive real estate portfolio is not some little footnote. It is a significant, heavy drag that will take a lot of time and a favorable market to repair. You have to add to that the constant, unpredictable threat of geopolitical uncertainty and the frankly monumental challenge of deploying $200 billion wisely in a very competitive market. The risk of execution error, of making a bad bet, is real. The potential for missteps is every bit as massive as the war chest itself.
So the final verdict from Iron Financial is this. Blackstone is, without a doubt, a financial fortress. It has foundations of solid iron and a war chest ready to go out and conquer new worlds. The upside potential here is enormous. However, and listen closely, investors must remain vigilant. You have to keep a very close eye on those significant cracks in its real estate pillar. Because if that pillar is not repaired, if it continues to degrade, it could genuinely threaten the integrity of the entire structure. This is a clear opportunity, in our view, but it is absolutely one that requires constant, active surveillance on your part.
And all of this, it leaves us with the ultimate question, doesn't it? For 40 years, Blackstone has proven beyond any doubt that it can master the traditional worlds of finance and real estate. They wrote the playbook. But the future is going to be defined by completely new forces, by artificial intelligence, by data, by a complete technological reordering of our society. So the crucial point for every investor to consider is this. Can the fortress they built to so perfectly dominate the old world withstand the inevitable siege of the new one? That, right there, is the trillion-dollar question you need to be asking yourself.